Good morning, everyone. Hopefully some of you are just logging in on now. I've got James here with me from Open Analytics. Thank you for those who can log on this morning. I'm just going to chat for a little while. I'm just seeing people slowly get on, as I think it was 10 o'clock and a few people will be getting the computer set up. Our session today is, what are you rating for? We decided to use this platform because Zoom and Teams can have some issues, so hopefully we'll avoid any of those. And also, we can't see you guys, you can only see us, so you can continue to drink coffee and work while you're listening in to us. Today is being recorded, so if you do need to leave early or you're registered and couldn't attend, we'll send you a link. It won't be the full live session. We have to do a few edits because James is going to reveal some of your intellectual data that we'll need to take out, but certainly you can watch this at another time. Also, you won't need to take screenshots because you can obviously replay the link when you get the chance. Some of you have met me before. I'm Josh, one of the Brisbane team members. If you didn't get your invite today from me, it probably came from Alex, Luke, Shannon or Erin, so you are in the right call. We thought we'd start with an online session. Due to COVID, it's made it difficult to organise events, and some of you are working from home. So today's chance is put a name to James's face, and later in the year, we want to get James into Brisbane and do an event around what he does. He's kind enough to give us some time to speak to us as he has a busy workload, and the aim today is for him to share his ideas around the ratings. Over the years I've been at Creditor Watch, I think every week I get a question about ratings. So for me, this is the #1 topic that people are most interested in. In the past 15 months, since November 2020, we've introduced the credit rating, the payment rating, and the financial rating. Today, James is going to talk about the first two, with financial ratings to come later down the path. The credit and payment ratings are looking at behavioural aspects, while the financial rating looks at that capacity to pay. So two very different areas, but both play an important part together. And those who perhaps haven't heard me talk about the topic before, I always mention how the credit report is a reactive piece of information. It's almost like a scoreboard. And in the sense that for things to happen, play needs to happen for that score to hit the board. So in risk management, that isn't ideal because you're basically waiting for the event to happen before you take action. So with Open Analytics coming into the picture, the credit rating they've started to really develop is our first bit of predictive data on that credit report. So without stealing too much of James's thunder, it's a tool you can use to understand and plan your actions with customers over that next 12 months. Some of you today are using ratings, some of you aren't, but as you'll hear James talk, you understand the important part it plays in the likely behaviour issues of the business that you may be dealing with. By understanding these ratings, we can give you a lot more insight to why things are flagging at the time. In some ways, we're a little bit guilty of, over the years, training you how to use Creditor Watch, but we've missed that education piece and why things happen as they do. So we want to improve that aspect, and this is sort of part of that process. If we can help you move away from being a credit administrator, more into a space where you're looking at risk mitigating factors, not only is it going to help you just individually, but you'll be able to better deal in areas of trade credit insurance, credit limit increases, and even in your PPSR side of things. Now, some of you sent questions in today, which I already gave James, and he's been able to look at that into his presentation. There is a function where you can add questions. James has put two parts into his presentation where we can stop and look at questions. So by all means, send them through. But I think ideally after this session, we still want you to send those questions to your rep, as again, this is just the start of a learning process as we do the ratings. And what we want you to do is get a sense of how much goes into these ratings. And James will probably touch on that he's working on more modelling as he improves the rating. And you'll probably find James a breath of fresh air because he's not an expert that worked in the industry 5 years ago. He's doing it right now. So I think that sometimes is the key. A lot of guest speakers come in talking about times that they used to do these things, whereas James is actively doing it now. So without pumping up his tires too much, yeah, I just thought that might give you a bit of an idea of where we're headed today. So I'll shut up now and let James sort of take over and present his bit of information.
Thanks very much, Josh. Thanks for the kind introduction. So yeah, as Josh said, the title of the talk is "What are you rating for?" So you can blame Josh for the cheesy title. But really, what I want to get out of this session really is two things. So number one is just to give some information. So as Josh mentioned, I'll talk about sort of credit ratings, different types of credit ratings, and I'll really focus on how they're built and probably most importantly, how to use them effectively. And in some cases, sort of where you can and can't use them, and sort of what's the sort of where you should target the use of credit ratings and other credit information. And secondly, and I'd say more importantly, is to just open a channel for feedback from you guys. So look, I always like these events are much better in person, but obviously, yeah, with COVID hitting, I've actually been dying to get into Queensland, both for work and to visit family. For your premier doesn't let me in, but so as Josh mentioned, I'm quite keen to get down there and do some live sessions and meetings with you guys as well. Okay, so look, it's a fairly long pack. I'll play it by ear, and I've broken it into sort of two parts. So part one, I'm actually going to spend quite a bit of time on the setup, and I'll talk about credit risk, you know, a bit of a 101 for credit, and really sort of look at some of the drivers of credit risk for the commercial space. So, you know, for some of you, there's a different audience, so different people with different sort of levels of knowledge. For some of you, this will be old hat. But even for you guys, yeah, I think it's worth the time to sort of set that up, because that'll help explain the best way to use things like risk or payment ratings. And sort of thirdly, I will actually touch on sort of financial ratings quite a bit. I won't describe them in detail, but sort of I'll talk about where financial ratings are more or less important for different types of credit and business types. Okay, so then part two, I'll really dig into, you know, explaining risk score and payment ratings, the actual tools that we're using. Okay, so look, to start with, I'll give a bit of background on myself, because you might be wondering where do we sort of fit in. So look, in simple terms, our company Open Analytics, we built the rating system for Credit Watch, and we essentially are their data science team and look after their data as well. So what our company does, we really do three things. It's basically data, models, and credit risk. And the background of our company is most of us came from the Big Four banking world. And so most of what our company does is build credit ratings, credit decisioning systems, primarily for banks, but also obviously for credit. But also outside of the major banks, we also do this sort of work for, you know, the smaller sort of second-tier lenders, and even in the utility space as well. So it's probably important to understand that, because that's sort of my background is sort of a bank credit world. So I'd definitely say there's things we can learn from you guys on the, you know, the nuances of things like trade credit and sort of more regular day-to-day business credit. Okay, so then just quickly, the sort of companies that we work with, you know, primarily sort of major banks and Credit Watch are our sort of biggest customers, but then also, as I mentioned, sort of second tier banks. We've been doing a little bit with government, and then sort of that sort of fintech sort of sector, and even utilities as well. Now, just to really simplify what we do, you know, we build models, predictive models that are used to control credit risk. And we do that sort of across the whole credit life cycle. So everything from acquisitions or marketing. So, you know, looking at screening before you even get to credit decisions, who you're actually going to target. Underwriting, which is probably the one that, you know, credit decisioning is probably the one that most people focus on. then after you book loans or any credit instrument, sort of portfolio management, and then through to collections. So that's sort of where we're coming at this from. And in some sense, what we've done with Creditor Watch, bureau scores tend to have a certain sort of look and feel and design a certain way. We actually, with Creditor Watch's rating system, we actually wanted to make it look and feel a bit more like a more sort of standardized bank rating system, in that it's a bit more sort of broad in terms of the sorts of data that feed into it. So it's less a sort of behavioral rating system, and it's actually looking at quite a broad sort of set of predictors. All right, so that's probably enough background. Okay, so some just basics of credit risk that are really critical to understand what we're doing with things like payment ratings and credit ratings. So 3 simple concepts. Number 1, probability of default, and that's really what underpins credit rating. So measuring sort of the risk of a loan, a bad debt going bad, or a loan going bad, sorry. So typically a default is often defined as either sort of a credit contract going 90 days past due, or in the extreme case going into external administration. So that's sort of concept number 1. Loss given default, I won't go too much into this, but it's sort of an important sort of thing to understand as well. So that's your recoveries. So for loans that do default, what percentage am I going to ultimately write off? Or in other words, 1 minus what you recover. And then expected credit loss, and that's really what sort of drives things like credit decisions and pricing and that sort of thing. And really simply, expected credit loss is what's the average percentage loss for every dollar lent to a particular type of customer or segment. And in really basic maths, the expected loss is basically the PD, or the probability of default, times the loss given default. So for example, assess the credit on a business loan, and they've got a 2% chance of default. Let's say your loss given default is 50%, then your expected loss would be 50% times 2% would be 1%. Now, it sounds basic stuff, but there's a lot of detail behind it, but all sort of credit decisioning really is sort of driven by those 3 things. So then what credit managers tend to do is look on the PD side. They tend to look at different factors that feed into it. I'll talk more to them in a minute. Same with the LGD side, things like collateral, insurance, things that affect the recovery prospects. They all sort of get thrown into a pot and boiled into a PD and an LGD. Then really the way most people see it is the PD is of course a credit rating, or credit scores sometimes as well, an LGD rating, and those things ultimately feed into a decision, i.e. will I give someone credit or not? And then where you do provide credit, what sort of pricing? And typically if you price for the risk, the higher the risk, the higher the price typically. And then if that wasn't sort of complicated enough, there's actually an important piece before you get into credit ratings and LGDs, and it's actually, well, I call them sort of time savers or policy exclusions. So think of these as simpler rules where you basically the don't bother rating category. So many lenders have, hard sort of policy knockouts, and in some respects they save you OPEX and time and money. If you have a policy not to, deal with, for example, startups, they tend to be very high risk. So many banks, for example, would have a policy that's either, a business that's less than 2 or 3 years old wouldn't even bother going through the rating process. It'd just be outside of policy. Then there's also financial things like, which I'll talk a bit more later. And then obviously really obvious bad behaviours for, things like bankruptcies for consumer, or sort of loan defaults on the commercial side and consumer side. All right, so that's sort of, basic concept. I think a lot of you will know a lot of that. So the first sort of thing where I think there tends to be a bit of confusion, around sort of, there's 3 different things that are more or less capture the same measure. So PDs, credit scores, and credit ratings, typically for sort of commercial or consumer lending for that matter, you're looking at sort of financial information, behavioural information, and demographics, or information on a business or a consumer. That goes into typically a statistical rating model, and you get a probability of default. So you get 1.85%. So that's something that's coming out of a model. What's a credit score? Now, credit score is an interesting thing. It's more sort of common in the consumer world. And there's sort of various sort of histories why kind of credit scores exist, but it's basically a simple transformation to turn probabilities into big round numbers. So actually, what a lot of people don't understand, it's actually purely an aesthetics thing. So back in the days, 30, 40 years ago now, when I think sort of FICO built the original sort of scoring models, the people using them sort of often sort of like to look at sort of numbers between 0 and 100, or so in some sense the credit score is quite a superficial number. And what can be tricky about credit scores is if you get a credit score, say within a big bank or at a bureau or anywhere else, what the number, say 500 or 600, because those mappings are pretty arbitrary, it can mean different things. So a 600 on one rating scale could mean a 2% default rate. It could mean a 10% default rate on another scale. So what is sort of more common in the sort of commercial lending space is then the last one, a credit rating. And all it is a banding or grouping of probabilities, right? So, for example, you might have a sort of probability of default range between 1.5% to 2%. Why those are created is that really for reasons around stability. So you actually typically don't need a 2 decimal point probability, because of course, remember, all of these things are coming out of models that have a uncertainty in them. So it's more typical to have, let's say, a set of maybe 10 ratings, which are all ultimately a range of probabilities. So, you could have a sort of B+ rating, and it might be sort of between 1.5% to 2% default rate. It is also can be conveyed in a score as well, but ultimately the score is sort of the middleman in some sense. So what we tend to promote the use of is the credit rating, because it's sort of, in practice, the credit rating is granular enough to make credit decisions. Okay, so then just an example of what a rating system looks like. So this is Creditor Watch's risk score credit rating. So, the first sort of, pro tip, basically on this rating scale, a C1 or C2 would be a normal business. So most businesses will be either a C1 or C2. If you're getting better than that, you're typically a very mature or very larger business. And then the high risks really starts cutting in at sort of that C3 level. We sort of think of the C3 rating as a bit of a sort of a borderline. So it's sort of the case where you wouldn't probably automatically extend credit, and you'd certainly want to look at things like financials before extending credit, or any material credit, that is. And then once you get into the Ds, once you get a D rating, that'll typically be some very obvious either behavioural issue or a demographic sort of, so you could be in the D rating, for example, if you're a startup bar, So there's certainly, it's not just about behaviours. You can get a high risk rating based on what type of business you are as well. Okay, so then just a big picture, whole country distribution of credit ratings. So that up there is about 1 million businesses that go into that chart. So that's all Australian credit active. I think they're ASIC registered companies. So as you can see, the average businesses are in a C1. C2 would be average for certain industries. So certainly if you're if you're in sort of hospitality or retail trade, C2 would be the average. So a C1 for a cafe or a bar would actually be better than average. But sort of if you mix it all together and just look at every business in the country, that's the distribution. Default rates, ultimately, as I mentioned, they map to a probability of default. So the whole point of a rating system is to pool debtors, whether they're consumers or businesses, into groups, i.e. credit ratings, and then each of them should rank order the default risk. So there's a graph on a log scale of the default rates. The red lines are sort of a longer run, sort of a longer period of time. The black dots are sort of a more recent time. So then this is sort of, that's on a log scale. On a sort of linear scale, so you can sort of see the real ramp up. You can see sort of if you're in the A ratings, they'll be very large companies, virtually zero default rates. C1 and C2 are kind of around that sort of average. C2 is about a 6% default rate. C1's about 3%. The national average default rate is about 4 or 5%. So you can see C1 and C2 there. And then you can see it ramps up very quickly. So once you're getting into those, C3s and Ds, you're more than 10% default risk. And then so that's sort of on a big pools on a sort of a large sample, a long period of time. But then what's sort of really important is how these things behave over time. So stability is really important. So a bit hard to see on this linear scale. So I'll show a log scale in the next chart. But basically, you can see the E at the top. So the high risks tend to be a bit volatile, but they're kind of always very, very high default rates. Down through the Ds there, and you can see down the bottom there, the dotted black line, that's Australian average, and you can see sort of C1 and C2 sort of consistently sit either side. If I put on a log scale, and look, the log scale is just a bit of a visual trick. It sort of it allows me to see the lower risk rating, so you can see there more clearly the the C1 and C2 around the average. Once you get down, the sort of Bs are low risk, and then sort of the As, you see that bottom line there is sort of 0.1 of 1%. So it's sort of 1 in 1,000 risk you're looking at for an A. The A1s, there's none on the chart because there's no defaults over this period. They're your very big companies. Think of BHP or Westpac Bank or things like that. So that's basically what credit ratings are designed to do. So it's quite a simple idea. So just pooling loans into categories of default risk, but there's a lot of sort of data that goes into them. Okay, so now that's sort of what credit ratings are. Now, how are they built? What actually goes into them? And I think that's probably one of the most common sort of questions that I get from different sources. Now, there's some really important concepts I'll cover here. And the first one is, when you're sort of conceptually thinking of credit risk, generally we break the world into three categories. So when you're looking at the risk of now this applies to consumers or business lending. But number one is financial, so balance sheet and cash flow, things like, a business is profitable, can they manage their debts, that sort of thing. Behavioural risk, that's exactly what it sounds like. Observed real-time behaviours, so things like transactional spending categories and repayment behaviour, then really adverse things like court actions, defaults, that sort of thing. And then finally, demographic risk, and that's sometimes also called business risk. These are sort of properties, more structural or intrinsic properties of a business. So some obvious ones are things like what industry are you in? Are you in the medical industry, or are you a farmer? Are you in mining, etc.? Location is a big one, and we, a lot of sort of work that we put into sort of location risk, which is really important for both consumer and commercial credit. And then things about the company. What's the legal structure? Is it a sole trader, or is it a publicly listed company, or is it a trust? And then you can go very deep into this. You can look at things like sort of supplier concentration and customer concentration and that sort of thing. So really important, all sort of well-made credit processes that are looking at sort of large sort of valued credit are looking at those three things in detail. Now, first thing to understand is it's quite common to collectively group together behavioural and demographic risk and call them, quote, non-financial risk. So that's sort of the first thing. So often what you'll see in rating systems for example, if you go into any major bank, when we're sort of assessing commercial credit, we actually have two sets of rating systems. So you'll have a financial rating, and then you'll have a non-financial rating that sort of groups those things together, so the behavioural and demographic. So I think the obvious question is sort of, why the hell do you do that? So you've sort of grouped two of them together. Why don't you group them all together? The simple answer to that is that what you tend to find is behavioural and demographic risk tend to be, those sort of models or risk assessment tend to be more automatable. So anyone who's sort of gone through the process of doing a sort of balance sheet assessment would know it normally takes some human effort and more time and cost to do a detailed financial risk assessment. And I think many of you will probably be sitting there thinking, well, I don't do that at all if I'm doing sort of short-term trade credit. So it's very much one of the key sort of questions that I often get asked is, well, when's it okay to just do a sort of light touch, automatable, non-financial risk assessment versus a full assessment looking at financials? So, so on that sort of vein, what you typically find is, there's a big difference in weighting. So you'll always get to a final credit assessment or credit rating. For different types of lending, different lenders, different policy rules, more or less you can think of it as a different weighting towards the non-financial versus the financial risk. Okay, so then given that, sort of where does sort of Creditor Watch's models and products fit in? So the risk score, the risk score rating that comes in the standard credit report, now that's what's known as an example of a non-financial rating. So when I'll actually show you some of the factors within risk score, and you'll see they're all sort of behavioural and demographic type information. Now, Creditor Watch through partners with Credit Source, and I think I saw that Shivantha might actually be in the audience, but typically for bigger companies, Creditor Watch partners with a company called Credit Source to do a full financial risk assessment, and that's obviously a lot more involved and frankly less automated than the sort of non-financial risk assessment. So to place sort of the products in there, and there's actually a couple more. So the other one you might be familiar with is the payment rating, which also, now the payment rating, potentially a bit of a misnomer. It's not a rating in the sense of a credit rating. It's a single factor that's looking at past behavioural information. And what I'll show you is that it's very much the case that there are situations where you can have quite a poor payment rating, but a good credit rating. And that typically happens with bigger companies. So I'll get on that. The last one there, a sort of demographic risk measure, is Creditor Watch's new geographic risk rating. So that one isn't readily available in the credit reports, but it's something in our data block. But that's probably the sort of fourth sort of piece in the puzzle, which is looking at a sort of location risk measure. So a lot of different information, but the short way to think about it, the aggregate sort of non-financial risk is risk score. Then look, if you're dealing with big companies or large exposures, then really, you really need a financial risk assessment. Now, this might not apply to a lot of the audience for the type of credit you're doing, but if you're doing a bank loan, for example, you would not be sensible to do a bank loan of any material exposure without looking at the financials of the company that you're lending to. Okay, so as I sort of alluded to, one of the crux of credit management in the commercial space could almost be boiled down to that question I mentioned. Where does it matter? Where does the financial, what should that weighting be towards sort of financial versus non-financial? So if you sort of look at what's sort of out there in the industry, so if you look in the banking and credit world, for example, top table there's, if I'm looking at sort of any sort of large exposure or a customer you don't know much about. So, a new to bank customer, for example. Now, in the sort of consumer lending to individual people, it's very much weighted towards behavioural factors. So, put a rough number on it, you're looking at things like serviceability and things like that for an individual consumer. But the most predictive elements on consumer lending are transactional behavioural information. That's more or less true for small business as well. So if I define small businesses, say up to 10 mil turnover, again, in rating systems out there in the industry, they'll tend to be weighted more towards the sort of non-financial. The reason for that is that, typically smaller businesses, sometimes they can have lower quality financials. So they're typically not, less than 10 mil, they'll always be non-audited financials. And you've actually got sort of the behavioural information is actually more correlated to defaults and insolvencies. That picture starts switching the bigger the business gets. So that the simple rule of thumb is that the bigger the business is, the more correlated the financials assessment is to the ultimate credit risk. So if I'm looking at a medium-sized business, for example, there'll be different weightings at different banks and different creditors, but more or less it will tend to be more weighted towards the financials. So if you're looking at a 50 mil turnover business, in your credit risk assessment, you'll typically be looking more at the balance sheet than behaviours. But even in that range, the non-financial rate's a pretty big part of the assessment. So you still look at things like credit reports and transactional payments behaviour and that sort of thing. Once you get to the big end of town, now it's pretty arbitrary where I've put these boundaries. But let's say sort of 100 mil turnover business, it very much is dominated by the financial weighting. To the level that it can be quite common for big companies to have some adverse court actions and poor behaviours, and it'd still be very low insolvency risk. So that's probably a good rule of thumb. Now, the other thing is well, what about if I'm not a bank and I'm not doing bank loans, which is most of the audience here today? Well, for different types of credit, where it's kind of a smaller exposure, so you're not, a loss on it isn't going to break the bank as much, or it's sort of shorter term credit, things like short-term trade credit, then it switches quite a bit. And the reason for it is really an OPEX and cost and practicality thing. So if I'm doing business lending, let's say I'm doing a short-term trade credit, it may not be practical for me to ask a customer for their financials. So it's not uncommon to be completely weighted to all of the non-financial information you can get your hands on, whether it's through bureaus or internally or other sources. The other feature here is that once you actually book a customer and you're doing business with them, then the weighting shifts even further towards behaviours. So I always sort of say the most predictive information any business has, if you've got an existing customer and their actual payment history with you, that's actually will be the most predictive piece of information you have. So what you tend to find, and this is true of bank loans as well, that once you've got an established customer with an internal payments history, then you'll shift the weighting in your credit assessment towards that. So if you've got a customer for, hasn't missed a bill in 10 years, you might even extend a credit to them without even looking at the financials based on their track record. All right, so that's sort of probably quite a bit to take in. But one thing you're taking out of that is that there is this financial and non-financial risk assessment, and it is important to understand if you can't do a financial risk assessment, understand how correlated to risk is the non-financial information. And the short, very simple answer is, the bigger the company, the more important the financials is. Okay, so then to summarize that, these are the sorts of questions that, I think anyone managing credit has to think about these things. So number one, what is that weighting towards financial versus non-financial? Number two, given the non-financial is much cheaper and faster to execute, what's that trade-off between, credit losses versus OPEX and customer impacts? And then that sort of leads to when is it okay not to do a financial risk assessment at all and just look at things like bureau scores and non-financial ratings. The other really important one, where do statistical models work and are more or less reliable? So that's an important thing to understand. These rating systems, ultimately they're models. They work really well on big pools of data and on aggregate, but you'll always be able to find an edge case. And typically if you've got a complex structure, for example, where you might have an entity that has 9 or 10 different legal entities linked together, once you get into that world, you typically need human beings to really, look at the balance sheet and really assess the risk. And then sort of finally, how do you combine all this information? All right, so unfortunately, there isn't just generic answers to all of those questions. It actually depends on each individual business and what sort of credit you're doing, how much risk you're willing to take on. But in part two, I'll try to touch on some things, particularly around that sort of combining financial and non-financial risk. So look, I might sort of pause there.
Yeah, I've got one good question that's come through. How often do credit checks influence the score? As I've noticed quite often that when we get an alert for credit inquiries, the ratings drop.
Yeah, that's a very common question I get. And I'll speak more broadly first. So in consumer credit, something that people often complain about is if I get a credit check, the consumer bureaus typically have a number of inquiries as an adverse factor. It's a bit different with commercial credit. Now, if you get a credit check, I can say categorically, it does not have a negative effect on your score at all. It has no effect. If you're setting customers up, there's a subtle effect if you're setting customers up on regular monitoring, and it actually has a positive impact. So we have various measures that look at sort of trade footprint and how many businesses you're doing business with. So if you're a company that has more than 5 or 6, I think, companies monitoring you, you actually get a slight benefit in your rating. So any credit check you do or setting a customer up on monitoring, it cannot reduce their credit rating.
Excellent. And probably another thing to touch on too, James, is a lot of our customers noticed when you did introduce the new rating, and you'd really touch on it, was that big ratings drop at some stage, and we had a few trusts in that same boat too. So I think one thing you've always explained quite well, and probably would touch on for people, is how you've sort of distinguished the difference between trusts and those ratings.
Yeah, trust is an interesting one. So trust, and I'll get to this when we talk to the changes we've made to risk. Obviously, in general, we're a bit too nice to trust. Although, look, what I would say with trust is trust can be by design there to put a barrier between, a legal barrier for creditors and the ultimate, you know, where you've got a company structure where there's, you know, a trading company and a trust. I would say you cannot just look at the trust alone to understand the risk. So I think you should, whenever there's a trust involved, you actually need to look at the full company structure and look at either the trustee. And then there's a big difference whether it's a kind of a trading trust versus an investment trust. So investment trusts tend to be very low risk, very rare defaults. Trading trusts in the new models, you'll notice that the average credit rating for those guys will be downgraded. And I would say where you see a trust, it should be a trigger. There could be a complex structure, and where there's a complex structure, then, you know, I'd say that you need to, yeah, there's actually limitations of these models when I've got a complex structure. So I think, one, you should use the score a bit more negatively for trusts. So I wouldn't, if I get a trust with an average rating, for bank loans, certainly I would still need to look at their financials. So I'd almost put a rule in that whenever you're dealing with trust, you almost have to look at the financials to really understand the risk. Incidentally, a customer of ours, they're a fintech lender. They actually have a different loan establishment fee if you're a trust, because it costs them more to do a credit check on a trust because there's more human involvement. So trust is, I'd put a ring around that and say that's something where, you know, that question around where are models more or less effective, I would say, you know, for trusts, I think you probably do need to look at financials.
Excellent. And just one more question has come through. How do you gather all the data? For example, when you have a new company, months old, no financials, how do you apply the correct weights? So basically a brand new customer, which, yeah, there's obviously those factors yet to sort of play a part.
Yeah, actually, there's a bit of a technical answer to that. So maybe I'll park that one because I'm actually going to show everyone all the factors in the rating system. But look, a short answer is if you're a new customer, you know, you'll get a really bad credit rating. So more or less, because I mean, if you look at sort of businesses less than, say, 3 years old, if you look at the empirical insolvency rates on them, they're very high. So that's why, you know, most lenders basically won't lend to a brand new business. So that's probably an overriding, you know, common sense sort of look at it. How we deal with, you know, in general, you know, we've got 30 odd factors in the rating system, and not every customer has every one of those factors populated. And we've got various ways of dealing with that. That's probably a bit more of a technical explanation to that one.
Cool. I think we're good to move to the next section.
All right. I mean, judging on those questions, I'm getting the sense that people actually want to get into the models themselves.
Yeah,
so
you're touch on. Yeah.
Okay, so then first of all, sort of risk score, what's new? So there's a few sort of important changes that are some updates that are going to be rolled out in the next month or two. So actually, the changes are all done and they're just sort of ready to be sort of implemented. I'd say probably the most important one is around large businesses. So at the moment in the rating system, we're using basically whether companies, you know, it's really important to separate bigger companies from smaller ones, as I sort of touched on before. What we've been using to do that in the past is sort of the ATO tax reporting status, and also a bit of we've basically got a big list of corporates based on Credit Watch's customer network. What we're doing is we're expanding our sort of what we call our large business segment, and we've actually got a specific model just for large businesses now. So basically we've put the threshold down to 50 mil turnover. So in practice, what this will mean is on that sort of companies in that sort of 50 to 100 mil range, we'll be sweeping them up into our larger company. And sort of those sort of companies that are just below the threshold for tax, ATO reporting, but still larger companies, will tend to be a bit nicer to them. So I would, having looked at sort of cases that customers have raised, there's definitely a few where customers are on that borderline where we're a bit harsh on their ratings. So in practice, you'll see a bit of a uptick in ratings for those sort of medium to larger size businesses in that range. Trusts, as I talked about now, we've sort of separated trusts into investment trust versus trading trust. And in doing that, we've actually made a few other technical changes that will more or less sort of downgrade trusts a little bit. At the moment, we're sort of giving them pretty nice grades. Then they'll generally be downgraded. The new payment rating, now that's a new sort of delinquency factor, which is just an extra behavioural measure, which I'll talk to a bit later on. And then the geographic risk, we've always had that in the rating system, but we've added some more data to that. So the geo risk rating or the location risk is a bit more dynamic than it was before. So more of actually using more of Creditor Watch's data as opposed to the sort of economic data in those geographic risk measures. All right, so cut to the chase. I think one of the questions, a really common question I get sort of, why has someone got a bad credit rating? And there can be all sorts of different reasons. But here's actually a list of all the factors across the different rating systems. So actually, I'm going to jump back onto this previous slide. An important point that on the left of this, you can see it's not one model. There's actually 8 separate rating systems because there's all sorts of different company structures and business types. So it's important to understand there's quite a different model for each company type. So you've got the large companies, public companies that are under that 50 mil turnover threshold. Then you've got sort of regular private companies, sole traders, partnerships, and then the trusts. So the new ones are we split out the trusts and the large entities. But across those 8 different models, these are the factors. Now, I won't go through every single factor. I'll just sort of talk to some themes. But the way that these rating systems are designed, it's really a mix of that behavioural and demographic factors. So in the sort of behavioural information, we broadly sort of split it into 2 groups. So more transactional behaviour. So that's the B2B trade payments behaviour. So things like the payment rating is one factor in the risk score rating system. Things like, what percentage of invoices are being paid on time, things around trade volume, then things around, the more adverse around invoice defaults. So that's probably group number 1, and that's all the trade payments data. Then I'd say the more classic behavioural high risk flags, things like, good old, court judgments, mercantile inquiries, and that sort of thing. Then down the bottom, we've sort of got the, geographic risk. I've got some stuff in the appendix, which I'll probably don't have time to go into this, but sort of location risk measures, things around age and maturity, and then also the things on number of directors and other things. So there's 30 odd factors, and look, as a whole, there's pretty much an even mix of those factors affecting your credit rating. Really important point, for a small business, the behavioural factors will have more of an influence than the demographic. So if I get, if I'm a small cafe and I've got a, trade payment default and a court action, you're going to have a really bad credit rating. If I'm a, 100 mil turnover, wholesaler, I could have those same sort of behavioural black marks, but I'll have a really good credit rating. So the way these models are designed, there's actually quite a different weighting to different segments on the different types of factors. And then, look, as I said before, the way to kind of use these things in a crude sense would be, C1, C2 and above are kind of normal businesses, or C1, C2 is a normal business. C3 and below is where you're starting to see some risk. Again, so this is sort of showing that I showed you the distribution before. Remember the All Australia distribution had sort of centered at a C1 rating. Now, for bigger businesses, the average is more like a B1. So as you'd expect, larger turnover businesses. So if you see a big business with a sort of a C1 or C2 rating, there's still, we'll still have the risk of those ratings, but it's an unusually high risk for a business of that size. So look, that's a quick rundown of risk score. Yeah, the one thing I would say is that, and I think something that Creditor Watch is definitely looking at. Now you'll see this list of factors. There's a lot in there. Now on the credit reports, you'd all be familiar with the little. Actually, I might share my screen and show the kind of the tiles at the front where you've got 9 different factors here. Now for a case like this, you can see okay, I've got defaults, court actions, ASIC, public notices, things like that. It's pretty okay. They've got a bad rating because they're doing lots of bad stuff, right? And then you can go down and see their payment rating, for example. This one, I'll pick this one. It's been in the news here. ProBuild, they've actually they're about to go under admin. You can see their payment days started blowing out, and their payment rating got downgraded to a D. This is sort of a case where okay, I can see this is a bad company. It's pretty obvious. There's other cases, and I didn't find a good. I quickly tried to find a good one this morning, but I couldn't quite get exactly what I wanted. But there are cases where I've got green ticks on all of these. You'll notice all of these things are sort of behavioural factors, right? This is a small cafe, and they got sort of a C2 rating, so average rating for that sort of business. But you do get cases that look like this, but that might be a C3 or a D1. Now, what I think a longer-term strategy is to actually make more of these factors that I've showed on my slides here available in the credit reports. Now, we can't. I think that's on the radar. When that happens, I think it'll be a bit down the track, but that's where we're sort of thinking along those lines. But some rules of thumbs, often when you see a case where okay, someone's got a bad rating, but it's not obvious why. It typically is to do with sort of demographics, and it'll be things like the maturity. So, if you're a 3-year-old business in retail, trade, or hospitality, unless you've got really, really excellent behaviours and really high turnover, you'll be a D1 or a C3. That's probably the most common case where that happens. The other one that's not as obvious is a really powerful factor is what's happening with the directorship. So there are cases where the directorship shrinks. So a really powerful factor is a change in the number of directors. It's actually in those behavioural high risk flags. Another sort of, I'd say an important risk factor that is in the model but not on that initial dashboard is that one as well, sort of change in number of directors. So they're probably the most common reasons where you get those cases where you've got weak credit rating but no sort of obvious behaviours. Okay, so that's risk score. Payment ratings, and it often gets, what's the difference between payment ratings and risk score? Right, payment rating is one of 30 factors that feed into risk score, but we sort of bring it out as a separate piece of information just because there is there's a type of business that is a bad payer but low credit risk for, low insolvency risk, I'll put it that way. So we wanted to have this extra dimension. It's just one piece of information. It's not enough to assess a whole business on, but it's information if provided to say if a customer is bad at paying their bills. So it's a really simple 5-point scale. I think you've seen it before. Most of you would have seen this before in the credit report. So basically, if you get an A or B, you're a better payer than the average Australian business. If you get a C, you're sort of in that sort of average range. We're probably a bit kind to extend that up to 30 days. So we really see the default risk start climbing at sort of that 30 days. So if you're getting a D rating, what it means is the average, not just one bill, the average of all your bills that we can see, you're on average 30 to 60 days late, and E is really bad. Sort of on average, you're more than 60 days late. Now you'll see in the sort of verbiage there that's in the tool, we talk about high repayment risk, and then we talk about risk, and we're careful to use the word for a small business. So really important thing to understand on sort of payment ratings, and this goes to that question, what I was talking about at the start about sort of relative importance of behavioural versus financial and things like that. This graph shows, this is the factor that actually feeds into the risk score rating model, the payment rating. So the vertical axis is a 1-year liquidation or default rate. You can see the A, B, C, D, E payment rating on the left. Now on the left is a regular business, and on the right is that large company, the new sort of large company segment. So you can see on the left is probably what you'd expect, that, you know, A and B are lower than average risk, C's near the average risk. The average default rate on this population is about 4%. Once you get to D and E, you know, you're sort of between 3 to 5 times the insolvency risk of, you know, someone who's paying their bills on time. Now on the right is sort of a large company. Now it's a very different relationship. It's still the same trend, but there's not really any separation between A, B, and C. D, you know, D is higher risk than A, B, and C, but it's not as high risk as even a small business that's paying on time. So what you'll find is, for big business, you can actually have a savvy CFO who's managing their working capital and, you know, basically pushing around their suppliers. So there's some, you know, famous names which I won't name publicly, but think of a lot of you would have seen in the media some big supermarket chains who really push around farmers. So, you know, big multinational, you know, billion-dollar turnover companies, that their risk of going insolvent is pretty close to zero, but they're really bad at paying the farmers. So the idea of this on the big companies, I can tell you that someone's a bad payer, but it doesn't always correlate to high insolvency risk for a big business. So, you know, on a small business, on the other hand, it's very unlikely that if all your bills are late, it's because you're managing your working capital. It's probably because you've got liquidity issues and you can't pay your bills. So really important sort of feature there of the payment ratings. So look, that's kind of those two things. So really they're in some sense quite simple things. One's just the average payment behavior. The payment rating risk score is an aggregated rating system that tells you default risk based on non-financials. Then look, I might just sort of finish on probably, I think the key thing to, if there's one thing you get out of this talk, it'll hopefully be this section. It's sort of, you know, when do financials and non-financials sort of cut in? So yeah, as I mentioned, when you're doing sort of bank credit, you're always looking at financial ratings. So you might have sort of some sort of rating scale. Now, I always sort of get the question, well, what if I can't do a full, you know, financial rating, or it's not worth the cost of doing a financial rating? Another really simple, you can do basic financial checks that underwriters use. Now, if you want to sort of, without doing a full financial rating, this is my sort of really, you know, poor man's financial rating model. So you really need to, most credit managers really focus on 3 things. So number 1 is the business turning a profit, pretty obvious one. So you wouldn't normally give a loan to a business who isn't. Can the business manage its short-term debts? Can it pay back its debts? And then is it, you know, can it manage its long-term debts, or is it too leveraged? So a really simple check to add to sort of a non-financial rating, and they're quite common. This is actually quite a common sort of check that, let's say in sort of fintech sector for banking. I'll just have simple rules on, I'll get the company's net profit margin. Now, a really simple rule, that has to be positive for the last 2 years. If it's not, it's a fail. Interest coverage, very standard, like how many times over can you cover your interest payments? There's a pretty standard minimum of 1.5. And then what's your total debt to your earnings? So debt to EBITDA. So, you know, for a small business, if your debt is more than 5 times your earnings, you're probably not going to get a bank loan. So if you want to do a real sort of quick and dirty financial check, you know, that'd be sort of good rule. And then look, on the other side, if your debt is less than twice your earnings, your interest coverage is 3 or 4 times over, and you've got 3 years of, you know, strong profits, then you'd be well above average. So then how, you know, let's say you do this very simple financial check without going to the trouble of a full credit rating. How would you use that in practice? Now, for a small business, how would you combine that with risk score? So first of all, on the small business, a less than 10 mil turnover business, you won't get any A's. The A's are reserved for big publicly traded company. But if you fail that check, then I would say don't give credit. So that'll be a high risk business, regardless of what a non-financial rating says. Now, if you've got strong financials, now remember I sort of said that C3 is a borderline sort of case. If you get a C3 but you hit that sort of strong above average financials, I would say you're still a good credit. So if you've got sort of borderline on your demographics and behaviours, but you've got a strong looking balance sheet, then that 99 times out of 100 you'd walk into CBA or Westpac and get a bank loan. I'd still say if you kind of adjust past mark for a really small business, you might say there's potential risk. Once you get to, let's say, over 10 mil turnover, so larger turnover business, and it's worth remembering, probably about more than 90% of businesses are under 10 mil turnover. So that first category covers 90% of Aussie businesses. If you're earning more than 10 mil turnover, I would say if you pass that basic, you're profitable, you can cover your interest coverage and your leverage is okay, then I would say, a borderline would still be okay and everything above that would be okay. Now, what about if you're a really big business, say over 100 mil turnover? Now, look, the simple message here is on the left, if you're doing any material credit, then my poor man's financial system I just described won't work. So if you're dealing with a big complex company, any sort of proper credit assessment will be 80% tilted towards financials. So if you're not looking at the financials, then you don't truly understand the risk of the company. So if you're doing any material large credit, then more or less my advice would be you have to look at financials. The credit reports are still a tool, and if someone's getting a D and they've got average issues like that case I just showed with the court actions, and then that should be taken into consideration. Okay, but if you're dealing with a big company and doing short-term trade credit, let's say a utilities provider, providing sort of gas services to a big company that's doesn't have any real obvious adverse in their credit reports, they're generally going to be a reasonable risk to take on for trade credit. So that's sort of probably a bit to take in. I'll sort of send this pack away, and I'm actually interested to get people's feedback on this, because all of this is sort of trying to address a lot of questions we get. How do we kind of combine different things? But now these are simple rules and probably rules of thumb that might work generally. Obviously, each company is different. You've got different levels of risk and costs and other things. But sort of hopefully that gives a bit of a background on how how a banker like myself would think about using all of this information to assess credit risk.
Excellent. No new questions, but I think what's important is everyone can just feel comfortable going away. And as James mentioned, we actually want feedback from you. And it will help when James does get that trip up to Queensland, because I think it will just add more content to what we talk about. But I think the aim today was just to show you how much is going into those ratings. So, you don't just see a rating and go, oh, well, that could mean whatever. There's actually a bit of science behind that. As James said with his equations, there's quite a bit, and there's so many variables. So I guess the aim is, if you do have a question, we always want those questions towards us. If you find a D1, and James' example of ProBuild today, his rating had at a D1 back in April 21. So it's been almost a whole year they've rated poorly, but a lot of those defaults and court actions hadn't hit that credit file until recent. So there was pre-warning quite some time before. So yeah, absolutely welcome more questions. And I think the main thing is thanking you, James, for taking your time out to sort of share.
Oh, no, thank you. Anytime. And look, like I said, I think these sessions, a presentation like that, you can sort of feel like you're being presented at. I mean, my real goal, I put my contact details on this pack, and often we actually want to hear from you guys as well. So I'll definitely be up in Queensland now that, touch wood, that COVID is dying down. I can get up there. And, you know, we're always sort of open to feedback and more sort of deeper questions on all this stuff.
Excellent. Conscious of time, we just hit on that hour mark. So I think, as you said, lots to take in, and yeah, we can certainly leave it there. As James said, we'll send out sort of a bit of a shortened down version of the slides, so you can have a look at that. And we'll also have the link. There'll be a bit of editing in there, as I mentioned, because some of that is intellectual property. So if the link doesn't quite seem right, there'll be a little bit bits and pieces changed, but otherwise, yeah, hopefully next session, as I said, we might look at doing financial risk ratings and potentially just sort of helping you get your head around all those aspects. So thanks again, James, and yeah, thank you everyone who was able to stay the whole hour.